Welcome to Growth Investing Mastery. This video will look at advanced adding and trimming of growth stocks. As a reminder, this is not investment advice or recommendations to buy stocks. The purpose of this video is to look at advanced topics in growth investing. We sometimes get asked about what are the advanced topics within growth investing, and the strategies for adding or trimming around earnings season can be challenging. Making moves correctly during this time frame is essential for strong results. This channel places a big emphasis on getting strong results. As of our last portfolio update, the portfolio was up 136% year to date and up 481% since the start of 2024. Let's now introduce some details of our earnings review process. We want to make the right play for each earnings report that happens in sequence. And if we make the right play for each report individually, we will have played optimally. I like to think of this as similar to a poker tournament, where if you play each single hand perfectly, it means you've played perfect poker. Additionally, we could use an analogy from chess. We want to move our chess pieces to the proper places, or allocate to the proper stocks in this case. It's important to have our strategy well defined during earnings season. Otherwise, we end up making random moves. This process includes doing preparation work before the earnings report. We want to look at the prior guidance the company gave, along with reviewing the earnings report itself, and any hints the company may have given at the next quarter's results. We look to make or create our revenue number, which is a number we will be happy with. Typically, our revenue number is higher than the company and analyst estimates. The benefit of this is it gives us an immediate objective barometer on how the report went. We want to read the press release before checking the market reaction. This is so the market reaction doesn't taint our analysis. And the percentage change that we expect the stock to make is more important than the actual stock's move. We then want to use the stock price reaction to make an informed decision with our own opinion, or your opinion. And I put your opinion in all caps because it's very important for growth investors to be able to draw their own conclusions and not rely on others for how our earnings report went. One big key insight is that we expect all our companies to do well, and this makes adding to our stocks before earnings to have a positive expectation. If we've done our analysis and research properly, we should expect all of our companies to overperform when they report earnings. However, it doesn't always work out this way, and some companies inevitably disappoint us. Let's first take a look at some example scenarios that can come up before jumping into more specific real-life examples. In the first example, we thought the stock would be up 20% on reading the earnings press release. But when we check the stock price after hours, it's actually up 40%. So we use this opportunity to trim the stock because we think the 40% price increase is a bit of an overreaction from the market. In the second example with a different stock, we also thought the stock price would be up 20% after reading the full press release and reviewing the earnings transcript. The stock rallied initially after hours, but then broke down sharply once the question and answer session started. But we checked the question and answer session around the time the stock dropped, and the situation doesn't sound concerning at all to us. So we use this opportunity to add to our position. So sometimes the market might latch on to a statement the management made in the question and answer session, and we want to pay attention if we really agree with the market reaction or not on that price movement. In example 3 for a third company, we read the press release for the company and thought the stock should be down 20% on extremely poor guidance, and we've also lost a lot of our confidence now after reading this press release. Miraculously, when we check the stock price, it's up 15% after hours. We sell 1/3 of our shares immediately and check if there's any reason that we might have missed that the stock should be up 15%. But in the end, we just do not have the same optimism the market does, and we sell the remaining two-thirds of our position and close out on this stock. Now let's take a look at some real-life examples of how we rotated between stocks during the earnings season. Over 1 year ago, Transmedics was our first company to report in the earnings season. And Transmedics was a high confidence position, making up about 15% of our portfolio. We expected a strong quarter, as all signs pointed towards business momentum. Yet the stock price had been tanking heading into the earnings report. And we did add a little bit to take advantage of these lower prices. However, the numbers Transmedics reported were a disaster, and the results left us scratching our head. The management team was simply unable to explain why the revenue number was so low. And right away, we were thinking, wow, this is the first report of the season, and we're already closing a high confidence position. We tried to look for any silver linings in the report, but we were unable to find enough to continue holding any shares. We sold our shares the next day during normal market hours. This left us with a lot of cash in our portfolio. At the same time, we had about a 5% position in Reddit, which was a company we started in recently. But our allocation in Reddit did not meet our confidence level, as we had high confidence in Reddit. So ideally, Reddit would have been a higher allocation if we had more free cash. And Reddit was reporting later that day after the market close. But we did have a little bit of trouble deciding, do we really want to go from a 5% position all the way up to 15% right away? One way we can build confidence about making a big move like this is to take some action. And the action we took was to reread the latest Reddit earnings transcript and do a quick sanity check here. The reread of the earnings transcript for Reddit left us even more enthusiastic than previously. This gave us confidence to make the big move of increasing our Reddit position from 5% to 15%. So we ended up moving all of that money that was in Transmedics over to Reddit the day that the company is reporting their earnings. The final outcome was that Reddit reported a strong number and the stock rallied significantly. We then trimmed our Reddit position in turn, as its allocation had already run ahead of its conviction. So we went into the earnings report with about a 15% allocation. But after the earnings report, Reddit made up nearly a 20% position. What we did in this case was to trim Reddit down to about a 17 or 18% position going forward. Let's take a look at a second actual scenario now. This past earnings season, we had a low confidence position named Powerfleet that was reporting earnings. The story for this company was a bit more complex than usual. It was a tri-merger of 3 different companies. And our take here was that there may be some growth, as their last earnings report had a lot of impressive elements of their narrative. The company had cited a massively growing backlog. They had AI video pipeline up 120% quarter over quarter, data highway pipeline up 50% quarter over quarter, and new logo pipeline grew 121% quarter over quarter. At the same time, we had a newer position called Iron, where we had a lot of enthusiasm and confidence for this position. But our allocation there didn't meet our confidence level yet. Powerfleet was scheduled to report in the morning before the market opened, and we really wanted to see Powerfleet show us why we invested, or produce a strong report. The company reported that revenue was flat quarter over quarter, and they said they raised guidance, but in actuality, they just tightened their guidance range. Now the story the company is telling makes 0 sense to us. The company had said previously they have this massive pipeline that's growing like crazy. However, the likely explanation is that they're cannibalizing their business via the tri-merger, or they're doing some fake cross-selling. Yet surprisingly, even though we were disappointed, the market rallied 20% on this report. So we were more than happy to sell all of our shares and roll all of that money over to Iron. And Iron was still scheduled to report later in the month, so we had a chance to get a boost from Iron's report as well. Taking a look at actual scenario number 3 and building off the previous scenario, Iron is reporting towards the end of the earnings cycle. We've already bumped up our Iron position to a nearly 17% allocation. And that's very large and somewhat unusual for us to start with this big a position, so it was very high confidence. The earnings for this company's report were a bit unusual as well. Heading into the report, we already had detailed statistics from updates the company gave about how their business is doing. The company was giving monthly reports on their Bitcoin operations, and their Bitcoin operations made up a majority of revenue. So the market should not have been surprised by the numbers that Iron was about to report. Simultaneously, we learned about a new company called Electrovaya. And again, our confidence in Electrovaya was higher than our actual allocation towards the company. Our plan heading into the Iron report was to trim some of our shares of Iron and increase our ELVA position after. Fortunately for us, the market really liked Iron's report, and it gave us a great opportunity here. Iron went from about $19 a share to around $27 a share after their report. And our allocation for Iron shot past 20%, making it a logical choice to trim. We'll also talk on a later slide about why we like to trim a company as it gets over 20% of our portfolio. Now taking a look at actual scenario number 4 from earlier this year. We have a high confidence position called Sezzle that's reporting earnings soon. And we do have some concerns about this company's user growth. The management team had changed how they reported user growth a couple of times, and this was a bit of a yellow flag. I wrote here that user growth concerns should have tempered our enthusiasm more. However, the stock had recently cooled off a bit. It got all the way up to $180 a share and then dropped to $140 closer to their earnings. We used this relative decrease in price as a reason for adding to our position before the report. Unfortunately for us, the actual report was a disaster. Our revenue number that we were expecting was 120 million, and the actual number that Sezzle reported was below 100 million. We sold all of our shares in the after hours market around $100 once we read the press release and saw the disappointing revenue number. And usually after we sell a stock, we don't go back and continue to check the price. However, we accidentally saw the price about 10 minutes later, and it was $112 per share. And this put us on a bit of tilt, seeing the stock rally so strongly just after we sold. So we sold about 15% of our portfolio at a much lower price than the market was offering just shortly later. A key takeaway here is that we don't count the stock rallying after we sold as a mistake. Variance is a huge part of investing. The better correction would have been to add less prior to the earnings because of our user growth concerns. Our decision to sell after hours was correct, because we wanted out no matter what. And we don't want to get fooled by the variance that the stock shot up after we sold to imply that we made a mistake. And some months later, the stock sits at $74 a share, proving out our point that selling at $100 a share was a good choice. One question that may come up for investors here is, what about capital gains tax? In our taxable accounts, Sezzle was up quite a lot in a short time frame, but we were still about 4 months from lapping long-term capital gains. In this case, where a company like Sezzle disappoints us this much, we just have to pay the tax man his money. Now getting into actual scenario number 5. The company Harrow is reporting earnings, and we have them on a watch list. We owned Harrow previously, as they are a promising growth company in the pharma space. However, we sold Harrow after what we considered to be a poor report. However, our intuition tells us this company should be getting back on track. We remember being surprised they actually had a bad quarter, and it sounded like they may rebound on the following quarter. But we didn't do any additional research or even review the prior earnings report to look for clues. We ended up taking a 1.5% position, looking to anticipate the growth. But the quarter ended up surprising to the downside again. The revenue number came in way lower than we ever expected, and we felt fortunate to get out at a 20% loss with how bad the number was. This time, the key takeaway is we did make a mistake here. One of the reasons was we were trying to force the action, and I was left wondering why. Did I just get too bored and wanted some action in the market? I had a gambler's mindset going in. Let's just roll the dice on this one and see how it goes. The trade itself likely had a positive expectation of return. However, the big mistake was mental game related. We did not follow our process properly, which in turn lowers our confidence. We didn't even review the prior earnings report, and we can end up second guessing ourselves a lot in these types of situations. I wrote in my notebook in all caps, "Let the opportunities come to you. Do not force." And this was really one of those moves that was forced by me trying to make some action where there shouldn't have been. The final conclusion is we are okay to make plays on earnings, but do the proper research and follow the process. Now that we've looked at some example scenarios and some real life scenarios, let's get back into some more strategy here. Our first topic here is adding or trimming based on confidence. We want our allocation in stocks to line up with our confidence on the company. Here's an exercise you can try at home. Create your ideal portfolio from scratch with percentage allocations. And ask yourself, how far does your ideal portfolio differ from your actual portfolio? This can give you some clues about how to adjust your portfolio to line up with your actual confidence. Some key points are that stocks running up or down will make our allocations deviate from our confidence. And it should be fairly obvious that a high confidence position can go down in price, or a low confidence position can go up in price. Here's a recent example to see how to think about this. We currently have 3 high confidence positions that are all equal in confidence. Those stocks are AppLovin, Astera Labs, and Iron. But recently the market took Iron on a huge run up. Meanwhile, both AppLovin and Astera Labs had big downturns based on negative stories about the companies. However, we didn't really buy into the thesis of these negative stories, so it didn't impact our confidence on these companies very much. The trio of stocks was previously allocated around 17% per stock. But based on those recent events, the actual allocations became that Iron was 22%, AppLovin was 14%, and Astera Labs made up 13% of our portfolio. And this presents the perfect opportunity to align the allocations more with our actual confidence. What we did was we trimmed about 2 to 3 points from Iron, and that gets us closer to 19% in Iron, 15% in AppLovin, and 15% in Astera Labs, which is closer to our ideal allocations. We don't want to get too overly aggressive with the trimming though, but we did take a first step in evening out these positions a bit more. The best type of days to perform this maneuver or swap are when one company is up and another company is down. For example, on one day, Iron was up 15% and Astera Labs was down 13%. Yet both companies are benefiting from the same AI tailwind. Typically, we like to trim stocks on big green bars up and add to stocks on big red bars down. However, this is much harder to implement in practice than it sounds. A lot of times, that big green bar up can hypnotize us as we stare at the screen. Likewise, a big red bar down can paralyze us with fear. So, we want to be cautious that the moves up or down don't end up hypnotizing or paralyzing ourselves. One last note to make is that these types of ads or trims are best made in tax deferred accounts if possible. Let's now discuss trimming an oversized position. Sometimes a high confidence allocation position goes on an enormous run up. Other times, a medium confidence position rallies so much it becomes our biggest position. These fast run ups can have the allocation in the company exceed our confidence. Here are some recent examples. Our medium confidence super micro position had 12x returns in just 9 months from 2023 into 2024. A second example is when our medium confidence position Sezzle had a 4x run up earlier this year. And our most recent example is with our high confidence position Iron, which had a 3x run up in just 2 months. We usually look to make the initial trimming decision as a company gets over a 20% allocation. If a company has a really fast run up and gets up to 22 to 23%, our typical play is to trim this down again to a 20% position. But sometimes a company keeps rising so fast, it ends up at 25% or even higher. We like to have a hard stop around 25% where we're likely to trim this position back to a 20 or a 23% position. The normal question that may arise is why not just let the winner run as they have a lot of momentum? One of the big reasons is that a mostly stress free investing approach begins to turn into a high stress approach when we have a really high allocation in just one stock. The 25% plus position can get us into the territory of where we can't sleep at night. And the phrase can't sleep at night is put in quotes there because it's a common phrase that investors use. The general idea is that some investing approaches are too high stress and they can cause us to lose sleep. A key takeaway here is that an oversized position is nearly guaranteed to cause emotional reactions. We should keep in mind that any company can fail suddenly, like Supermicro did with accounting issues. Just imagine for a moment you have a 30% position in a company, and you see in the pre market it's down 50%. That event is likely to cause an incredible amount of stress for an investor. We can mitigate this by keeping our positions around 20% or lower. And this way, if a stock has a devastating drop or some incredibly bad news, we can recover a bit easier. And that's both financial and emotionally from that down drop. Let's now talk about pre-earnings season trims and ads, or the season when companies are not reporting earnings. We want to look for opportunities in the markets regarding our stocks. A good way to do this is to see what's up big or what's down big on a given day. Let's take a look at a really recent example with the company Hive. They had a big down day where they were down 15%. And the following day in the morning, they were down another 18% on top of the 15% from the prior day. With regards to the relative price, we remember the stock crossing $7, and now we're seeing it sitting below $5. The next course of action is to check the news and see if there's any stories about Hive, or if they have any press releases from their investor relations page. And we didn't find any news about the company. We even went to AI and asked AI if there was any stories about Hive on the day, and it didn't seem like there was anything significant. So we were presented with an opportunity to add to a medium confidence position in the morning, but we didn't end up taking this opportunity. This company is medium confidence because we know this company is likely to crush analyst estimates based on the recent updates they've given. Our mistake here was assuming that maybe somebody knows something. And some of the times there could be an actual news story we're just missing, and the company could have a problem. We want to remember the market is like a river. Sometimes it's flooding, and sometimes there's a drought. However, an efficient market is not equal to an oracle on total knowledge, and market participants as a whole act as dumb money. In this case with Hive, the stock rebounded heavily after the market opened, as others took advantage of the anomaly here. We ended up getting hypnotized or paralyzed looking at the stock price of $4.70 rather than acting. And the stock ended up opening at $5.70. So we could have made a really nice play if we took advantage of the opportunity here. We're not going to be right all the time, and that's okay. Like I mentioned before, there could actually be non public information that people are trading on, and there could be a real problem with the stock. And that's what makes this an advanced topic in growth investing, that there's a lot of subtlety here. The lesson for next time here is to not hesitate when we see a big opportunity or an anomaly that the market is offering. Let's now talk about how being passive in the markets is a losing strategy. I got this idea from Mark Douglas, who said the market allows you to be a passive loser. Many growth investors plan to never budge no matter what a company reports. In a lot of these cases, the investors aren't even reading the earnings reports. And it's typical they'll judge the success of the report based on the price action. So the mistake is to assume if the stock is up, that the report was really good. But if the stock is down, it means the earnings was poor. And I left two open questions here. The first is, how do you know if it's a good report if you didn't read it? The second is, do you want to be like the rest of the market, getting average returns? The correction here is to make sure you read the earnings report. Reading the report takes about 1 hour. By reading the report, we will be more informed and have a much better idea if we want to add, trim, or stay at the same allocation. One more open question is, can you really make the case that you don't have time to review the reports? We just mentioned reviewing the report takes about 1 hour. If we own 10 companies that report over the course of 1 month, it's about a 10-hour time commitment in the month. And if we're looking to get really serious and become an advanced growth investor, then this is a fairly modest time commitment to ramp up here. And a lot of times I'll see investors have a common misconception about this channel, Growth Investing Mastery. They assume that we're spending all day looking at stocks, and that's how we get results. But at least in my experience, we're spending much less time than we would at a corporate job, and the stress is lower overall. One last point to emphasize here is that reading the transcript will boost confidence in the stock, or it will lower it. But either outcome is good. If we have increased confidence, we can add, or if we have decreased confidence, we can trim. Let's now talk about one more important reason not to be passive in the markets. Stock prices tend to drift in the same direction they had after their earnings report. This phenomenon is known as post-earnings announcement drift. It's the only phenomenon that efficient market hypotheses accept. The implication is that if a stock delivers superior results, the stock tends to drift up over the coming days and even months, but it's strongest in those first 3 days. Likewise, on the downside with a company reporting disappointing results, that company tends to continue downwards. Here's some examples on the exact same stock. The company Sezzle was at $55 a share, and reported an incredible report. The stock moved up to $77 a share in the after hours. But then over the course of the next 2 months, the stock rallied all the way up to $180 a share. And there was no major additional news or catalyst for the stock. On the next report, Sezzle saw post-earnings announcement drift in the opposite direction. The stock went into earnings around $140 a share, but they have a disastrous report, and the stock immediately trades down to $100 a share. And 2 months after the report, the stock is at $75, still drifting lower. The theory behind this drifting is that the market cannot digest all the news at once. New market participants take time to wake up to the results, especially on lesser known names. And if you think about how our strategy works at Growth Investing Mastery, a company may report great results, but we don't learn about it till a few days later, or maybe a few weeks later. Another really important factor is that institutional money moves really slowly. They may only meet once per month or once per quarter. So let's say there's a pension fund and they make monthly adjustments to their portfolio. A company reported a bad result on August 7th, but the pension fund team doesn't meet until the beginning of September. When they meet in September, they may end up selling the stock there, making the stock drift even lower. A really common mistake that growth investors make is waiting to sell after a poor earnings report. And that investor may wait days, weeks, or even months while their stock drifts lower. Now let's discuss the unlimited nature of markets and the unlimited number of scenarios that can happen. Appreciating the uniqueness of each market opportunity increases our returns. However, the attitude of most investors is more like, aha, I've seen this before. I know how this goes, or I know what happens next. And a lot of times, this investor will have a know it all attitude, blocking out key information. If you already know it all, then there's nothing to learn. Another subtle mistake that some growth investors make is to immediately try and compare a new company they're learning about to a previous investment. You'll often hear this is the Amazon of, or this is the Netflix of. But in reality, we would do better if we had a completely fresh perspective on every individual company. Because of this uniqueness, it's impossible to give a full, discrete playbook of all the scenarios that can come up in the market. And if we want to get really strong results, we need to approach the market with a beginner mindset. I really like this phrase, Zen mind, beginner mind, which encapsulates how I should be thinking. We need to be open to receive new information, but some of that information is news we do not like, and some of that news may even cause pain. We can use that pain or emotion as the signal to investigate more. And some investors find it really hard to reevaluate a company once their initial opinion has formed. Reevaluating a company means we may have misunderstood something, or we may have just made a mistake. The wrong reaction to make when we get bad news about a company is to bunker down and to try and prove the doubters wrong. But the correct reaction and philosophy is that we are open to all possibilities of what may happen next. Let's now talk about getting blinded by bias. One of the hardest things to do in investing is to sell a company that we love. It's easy to get attached to the mission or the leadership team. And it can be easy to get attached to a product we like or a product we actually use. For example, the company Transmedics was solving an important problem that saves lives. And there was a lot of details I liked about Supermicro. They said they were building a superior engineering organization with a founder-led vision. And the Supermicro CEO was friends with the NVIDIA and AMD CEO. He had the perfect connections in the industry. One more example was with the Celsius energy drink, which we found to be superior to Red Bull. The takeaways are that we need to be cautious not to get blinded by our own enthusiasm. If we really like a product, it can be hard to accept it is not winning in the marketplace. And we want to take care to avoid the cult of personality around leadership teams. Oftentimes, this extreme reverence for the leadership team also corresponds to an overindulgence in product research. We may have seen presentations and speeches from leadership. It feels like we know the team and we know the product well. We may end up buying into the vision completely. The correction here is to stay detached from the leadership team and from the product for our investment choices. We may need to part ways with a company we love, especially if they have a disappointing earnings result. We want to let the company results drive our decisions, and blind commitment to product or leadership team will kill our results. Let's now conclude with some final thoughts on advanced growth investing. Adding and trimming to a stock, especially around earnings time, is an advanced topic in growth investing. The earnings season puts additional time pressure around making proper decisions. It's important to know that to gain confidence in our companies, we must do our own research. By doing our own research, in turn, we can confidently add or trim to our companies in an intuitive way. We should also keep in mind the possible outcomes in the marketplace are unlimited, and we need to play the hand that the market deals us, not the hand that we wish the market dealt us. Some key takeaways are that arrogance attached to the stock price and a particular company outcome will kill our returns. Additionally, bunkering down on a stock that we love is a costly mistake. This leads to not reevaluating a company on negative results, which is another costly mistake. Being passive regarding our portfolio is an underperforming strategy. Having an open mind that is receptive to new information improves our returns. We can build confidence in our positions by doing research ourselves. We want to align our portfolio allocations to correspond roughly to confidence levels. And we look out for scenarios where our ideal portfolio diverges from our actual portfolio. We then make adjustments. Mastering these advanced growth investing techniques will greatly improve our results. This concludes the video on advanced growth investing. I'd definitely be interested to hear your feedback on these topics included in the video. As a last reminder, this is not investment advice or recommendations to buy any stocks. Thank you.